am I am out of the office at the moment, so I'm in Brisbane. So I'm just going to introduce Bryce. But for those that haven't joined before, Bryce is from Vanguard. Unfortunately, I think this will be your last presentation for us, Bryce, because you have got a promotion. So congratulations.
Oh, thank you.
Next time, I think it'll be James Noon who's going to give us an update. So, but yeah, Bryce, I'd really like to thank you for doing these updates. It's been a great way to sort of get a good overview of where markets are at. There's no real bias. Vanguard, I like the way that they go about things as far as it's not. It's just the facts on the economics. So it's been great. It's been great to be able to have that to share to our clients in amongst these times where, while they're probably not there's not as much turmoil as there was, there's still plenty of things that are going on that will affect markets into the future. So for those as well, if you're chasing recording, we'll send a copy out. We'll also have a copy on our podcast as well. We like to sort of have this as a bit of an open forum. Bryce is happy to take questions throughout. So just sing out if you have any questions as well for Bryce. I do have to duck off now, but I'll leave you in Bryce's capable hands. And once again, thank you very much, Bryce. I'm sure we'll stay in touch, but yeah, thank you for all your contributions.
Perfect. Thanks for that, Brendan. And I really appreciated you guys letting me come along and present. But yeah, as you said, a bit of a change here. I'm looking after and going to be focusing on the Victorian market. And James Noon, who's a good colleague of mine, will be taking over Queensland and will take my spot here at these presentations. But you'll be in good hands with him. Just want to say as well, like as Brent mentioned, happy to take questions throughout the presentation. So if you're on the line now, feel free to unmute yourself or put something in the chat. Or if you listen to this after the fact, feel free to send an email through to Brent and he can pass it through to us. And we're happy to come back to you after the fact if you do have a question that you couldn't raise today. Just give me a second while I set this all up so I can see if there are any questions come through in the chat while we're going, but just one moment. Okay. Perfect. So as Brent mentioned, just for anyone listening now who maybe didn't start, so I'm here representing Vanguard and I'll be giving you guys an economic update, which will be mainly focused on the first quarter of the year, ending sort of the March quarter. We'll have a look at the continued market recovery we're seeing from COVID so far and also the impact we're seeing at the moment of inflation on the market. So you might have heard a little bit about that through the news. I'll look at what challenges and opportunities are presenting themselves in the market. And as I mentioned, just feel free to fire away any questions if you do have any. Just a reminder with all these presentations that we do that everything we talk to is all general in nature and not personal advice. If you do have anything related to your own circumstances or you do want to get personal advice, feel free to reach out to Canars and they'd be more than happy to help you if you're not already dealing with them. As I mentioned, I work for Vanguard. We're one of the world's largest wealth managers globally. We've been around for over 40 years now, starting in 1975 out of Malvern, Pennsylvania. Something special about us is Melbourne was actually our first office out of the US. So we've had a long-standing tie with the Australian market here, opening about 25 years ago in 1996 out of Melbourne. So had long ties to Australia and really saw this as a good market to be in. We update these slides quarterly. However, as of last month, we did just tick over 10 trillion assets under management globally, which is really incredible support from our investors. As we do like to grow naturally, we don't acquire other businesses. So this has come from all natural growth. And one thing I've mentioned in the past that sort of sets us apart from our competitors is our mutual fund structure. And I thought I'd touch a little bit more on that today before getting into the update. So for us, we are really client focused. We like to bring low cost investing to our clients and also have long-term thinking that aligns with the investment horizons of our clients. And it is, obviously we do hear a lot of firms say that they are client focused, but from our point of view, it's pretty hard to say that you're client focused if you have third-party shareholders to consider. As I mentioned at Vanguard, we are a mutual structure, which means we don't have third-party shareholders. We effectively are owned by our end investors. So what that means is when we make profits, we don't have to use these to pay out a dividend to shareholders. We can actually use them to lower our fees across the globe here in Australia and overseas. And what I'll show you is sort of the proof behind that. So as you can see here, what we've charted is the average cost in the US market of our products versus the industry average. So you can see through that mutual fund structure, the average fee today for an American fund is 9 basis points or 0.09, which is about a fifth the cost of what the US average is. And as you can see, we haven't been in the Australian market, for as long, but with that scale that we're growing over time, we are about a third the cost of the Australian average. So that's sort of the power of the mutual structure, where we are investor led, and any profits we make, we like to give back through lower costs to our investors. Moving on though, I'll touch now on what we saw over the last quarter. So before I jump into the forward-looking analysis, which everyone's always interested in, I'll run through what we've seen in the markets so far this year and how we've seen the vaccine and COVID continue to progress. Unfortunately, being here in Victoria, I am sort of living in it. We haven't been able to quite shake the grips of COVID just yet. So what we've charted here, for you all just to run through it quickly, is on the left-hand side, we've got the returns for the quarter to date to the end of March, so the first 3 months of the year, in comparison on the right-hand side with the returns we saw for the full year last year. So you can sort of see the comparison there of what's happened in the markets just within a very short time frame this year versus what we saw with the big dip last year and the subsequent recovery. So what we've seen is global investment markets have continued to build momentum from last year, and this continued over the first quarter of the year. So we saw global equities manage to close sort of 17% above where they were at pre-COVID highs, so about March last year. And then within the equities themselves, we have seen the US again continue to outperform the rest of the world, coming in at around or just under 8% for the first quarter this year, continuing that sort of performance of 8% last year. And then on a global scale, we've seen global returns of 6% so far. The reason we've seen that US outperformance once again was due to that passing of a larger than expected 1.9 trillion fiscal stimulus package. So that was more than we did expect that to pass through, but not to that scale. And then also, I'll touch on shortly, the aid of the accelerated COVID-19 vaccine rollout programs. They're well ahead of the rest of the world in that space. On the Australian side, we have seen the share market lag a little bit behind the rest of the world overall. So as you can see there, 4.2% compared to 6%. What we're seeing though is an improvement from last year. So last year was 1.7% for the year, whereas we've already seen that close out 2.5% higher in the first quarter so far. On top of that, we're also seeing value stocks in particular recovering really well as investors have welcomed a return to relatively normal conditions as we're starting to see that reduced impact of COVID. On the fixed income side, we've seen US Treasury yields rise by about 86 basis points over the quarter, taking us to around about 1.7%. This is a level in fixed income that we haven't seen since January 2020, so pre-COVID. So seeing that return of slightly higher interest rates, still very low, but higher than what we've seen. But with that, we've seen fixed income, unfortunately, suffer as a result when it comes to the capital performance. So as you can see there, a reduction in performance in this first quarter, and that's largely due to the increasing interest rates and also a bit of the scare we've seen through inflation. This may be concerning, but we only view it as a short-term impact when it comes to bonds. We don't see this as a long-term concern for investors. So if you are looking to hold bonds for longer term, we still see them being a really important role in your portfolio. So nothing to panic about at this stage. On the COVID front, we've seen vaccinations underway around the world. And with that, we've seen the number of COVID-19 cases, hospitalizations and deaths throughout developed economies have a much lower number than we saw at the start of the year. And we see this is going to pave the way for a significant pickup in economic activity in the second half of the year. We see this is especially the case through the US and the UK, which have been able to accelerate the number of vaccinations over the recent months. So you can see here this chart's to the end of March, but you can see it even at the end of March that the 30% of the US and roughly 50% of the British population had received at least one dose of the vaccine. I'm sure that's probably much higher now at the rate they were going. But if you compare this to the numbers we're seeing at the end of the year or early in January, I mean, they're only at around about that 1 to 2% range for the start of the year. So you can see how quickly once that goes and the take up of their citizens went for it, just how quickly that can go. And unfortunately, if you compare that closer to home, the vaccination progress here in Australia and also in China has proved to be much slower. We see this as due to the effective containment that we saw to date so far of the virus, even with some small snap lockdowns around the country. It has meant that our pace of economic normalisation was able to resume a lot earlier and is less sensitive to vaccine developments. I mean, hopefully some of the stuff going on now might help with promoting vaccine adoption and really sort of push us to the next level. But for now, we're in a much better state. I mean, if you look at the right-hand side chart here, which is the daily deaths per 100,000, I mean, you can see the COVID impact through the UK and the US. So the UK, I'll get my pointer out here. You can see the UK, that just the significant numbers they're seeing in their peak periods. So whereas if you follow along here, China in the purple and Australia in the orange, just the little blips that we saw compared to some of our more developed countries. So that's sort of the advantage we've had. I thought I'd quickly just mention, I mean, you might be looking at going, how has Israel done such a good job when it comes to vaccinations? And I thought I'd quickly just touch on that. So Israel's quite fortunate in that they've got quite a small population of 9 million and also a small country. So one of the big things with the vaccine is the ability to transport it and store it, as it is quite different as we store it at certain temperatures and quite hard to move. So because they do have their population quite densely populated in a small area, they're able to get access to it a lot easier. They also have a much less strict policy around who's been allowed to receive it. So here in Australia, we're very strict around who was able to be available to it in the first tranche of waves, whereas for them, anyone who was eligible, the rest of the family was also eligible, which means a lot more people were taking up the access of the vaccine there. Looking ahead, we are expecting economic normalisation to continue to pick up, particularly through the US and the UK. The US passing that 1.9 trillion fiscal stimulus package has led us to upgrade our GDP growth forecast by around about 2 to 2.5% for the rest of this year. So quite a significant upgrade due to that fiscal stimulus going through. With that stimulus, though, we have seen some investors become worried about inflation as a result. So if you combine the stimulus with pent-up savings, it has caused a bit of an excessive pickup in inflation. And the concern now is whether or not that will trigger a tightening of policy that could be damaging for equity markets, so potential for increased interest rates earlier than usual. However, from our point of view, despite the upgrade to the GDP growth forecast for the year, we are expecting that the direct effect of inflation of the recently enacted stimulus package to be relatively modest in the long term. As you can even see here, we did have this partially factored into our forecast for future PCE, which is the Consumption Expenditure Index. So you can see here, we did expect that along with the savings to have that effect through the US markets as they start to return to normal. And also we're expecting supply to start to pick up as well as borders start to reopen as well. And that's partly why we don't believe the inflation will be a long-term factor. As you looked at these sort of areas on the right, we see functions such as unemployment levels, the amount of globalization, technological advancements, as well as also the psychology around inflation. So if people perceive inflation to remain low, that does have a pressure on keeping inflation at a lower amount. So looking at those, we would need to see really large movements in those areas, around about 15 to 20 standard deviations on average, in order for inflation to remain high for a long period of time. So that's a situation we think is quite unlikely in the near term, which is sort of why we sort of still have that the opinion that we're going to see some modest reflation at the moment, but we don't expect to see long-term high inflation. So we still expect it to sit somewhere around that 2 to 3% mark, which is the target for the RBA. In Australia, though, we are still continuing to see really good economic recovery that's underway, and that is due to that effective virus containment measures. So what we've charted here is using Google's mobility index, which looks at retail and recreational activity within a country and just shows how much of that is going on and how much that's been impacted. So what you can see here, these green bars show at the peak of COVID lockdowns, how far off normal amount of activity we were seeing. So here in Australia, getting down to almost sort of 50% from where we'd normally be, but recovering nicely now at the end of March, only being about 10% off where we should be. So putting us in a really good spot for the second half of this year. And as we can see, though, if you look at some of the other developed countries like the UK, they're still really trying to get back to that pre-COVID levels. I'm sure they'll see a bit of a ramp up with those vaccinations going on. So we're hoping they as well will catch up towards the back end of this year or early next year for some of those developed peers. What we see is probably the key risk due to that effective containment of COVID. The key risk for Australia really lies with the rollback of the JobKeeper payment scheme, which happened at the end of March. We've seen that scheme being really beneficial. I've talked about it in previous presentations just on how much it's benefited the Australian economy, but we've seen it benefit millions of Australians. So we would have viewed probably without that JobKeeper scheme in place, the additional job losses could have been around about 700,000 higher than we saw. And that unemployment may have peaked at around about 12% instead of the 7.5% we saw last year. We saw that really effectively keeping people in their jobs and continuing to, I guess, stimulate the economy. Key challenge ahead is, I guess, how the labour market will fare now that those 1.1 million or so people that were in the JobKeeper scheme have been rolled off. I mean, if we were to see all these people lose their jobs, of 1.1 million extra people, the unemployment rate could spike to around about 13.8%. But what we view though is, I mean, even with a bit of hindsight now, a couple of months on from the end of March, is that hasn't been the case and that people have been able to find work or at least retain work. And a lot of that assumption around people losing their work probably overstates the amount of workers that sit in at-risk jobs that were benefiting from JobKeeper in the last quarter. Given Australia's minimal COVID-19 restrictions, many companies that were qualified for JobKeeper in 2020, particularly here in Victoria, won't feel the need to lay off their employees in the second quarter because they will see a sort of a pickup in demand return in those areas. But what we see though is still a bit of an unevenness between certain sectors. So service labour being demanded is still sort of down from where it usually would be, but we're seeing that being slightly counteracted by additional demand through construction labour and also manufacturing areas. So we're seeing that those will partially offset the overall unemployment. And just to add to that, we're also saying we're seeing an uneven unemployment recovery. What we're seeing is there's, I guess, more job loss in high-risk sectors. So that sort of includes your aviation, hotels and accommodation, arts and recreation. So those ones you're seeing sort of at the top of the chart here. And what we view is those are still being impacted by ongoing international border closures and also the continued restrictions on large-scale public gatherings in some locations. So with the snap lockdown we're going to see in Victoria, that's probably going to push back some of the more public events that were probably slated for later this year. So you can see there, the green bar shows the 3-year pre-COVID average, so what you probably expect to see unemployment-wise in those industries, and the blue line is the recent data from November. So you can see in some of those transport and arts and recreation, the unemployment sort of 2 to 3 times where it normally would be, but then partially being offset by reduced unemployment through education and training, wholesale trade, resource areas and manufacturing. So there's sort of that counteract level, so that's sort of picking up some of the slack that we're seeing from other areas. On our global market outlook, we saw earlier in the piece that global equity markets have continued their climb in the first quarter. They've managed to do this while navigating a shaky period for the bond market through all the volatility, and have actually managed to end near all-time highs at the end of the quarter and continue to climb. We've seen this despite a repricing of inflation, and we found that markets were able to get comfort in the prospect of a stronger economic growth later in the year. As I've shown in some of my previous updates, what we do is we like to look at the 10-year annualized outlook. And the way this is done is our economists run sort of 10,000 simulations through what we might see as economic outcomes and market outcomes. And what they do is they then have a range of potential return outcomes you might see, ranging from an optimistic view to a pessimistic view. So what we can show here, and the way to interpret this, is these blue boxes in the middle here are sort of our central expectation, or what we expect to be the most common occurrence, so the middle occurrence, with the green being what we would see in a optimistic or a positive market scenario, and then the purple being what we might see in as a pessimistic or maybe, and unfortunately, the worst case scenario type environment. Typically for these though, we do like to focus on the dots in the middle, so the grey triangle referring to what our forecast was in December last year, with the red being our updated forecast given what we've seen in the first quarter so far at the end of March. So With rising yields combined with a strong gain in equities year to date, this contributed to our opinion on valuations that they are broadly more elevated than usual, and maybe slightly less attractive than before. So despite the sort of support of near-term economic optimism, we're seeing that these movements have actually reflected in a small decline in our 10-year annualized outlook for equities. So not massively, but you can see there with the Australian equities, that's been downgraded by around about 0.5% on average over a 10-year period. And then with global equities, around about 0.2%. So not massive movements, but still a downgrade given those really strong performances we saw in the first quarter this year. On the fixed income front, however, though, we've seen recent rises in interest rates and inflation risks have left many investors questioning the appeal of bonds. However, when we looked at the composition of fixed income returns, we actually see that rising interest rates could actually be a good thing for long-term investors. So as you can see there, our return outlook for bonds has been slightly elevated. So you can see there for Australian bonds, 1.1% up into 1.7%, and for global bonds, 1.4 up into 2%. And that's largely due to, I guess, as interest rates rise, yes, it does have a negative pressure on the value of a bond. But what we see is there's actually two other parts to bond income that you get. So you get a yield distribution and you also reinvest your income. So as your bond pays out income, you're actually reinvesting that into bonds now with a higher interest rate. So if you are looking to invest for a longer period of time, you're now going to start to receive higher interest rates out from your bonds. So that's why you can see that income coming out of bonds increasing. And actually, if you looked at a 60-40 portfolio there, it is looking to potentially offset some of the reduced forecast for equities. So you can see there a 60-40 portfolio holder, even with changes to equities and changes to bonds, you can see now that their outlook is still around about 4.4% over a 10-year period. So we still have a very conservative view of the markets over the next 10 years. We're not going to see returns like we've seen in the past, but we still see that both bonds and equities are playing a really important role in portfolios. And just with bonds, I guess one thing we like to, I guess a nice rule of thumb we like to think about when it comes to bonds and worrying about maybe what's happening in the short term with them is as long as your investment horizon is longer than the duration of the bonds you hold, we don't see rising interest rates as a problem because you will be looking to reinvest over that period. But if you do have questions about maybe the bonds you hold in your own portfolio, it might be a good chance to speak to your advisor, Canars, and ask the question about what your portfolio is made up of and maybe what your outlook looks like. To bring these outlooks together, economists have used a forecasting model that looks at the real return potential that may be generated from our diversified funds and also what the potential for downside risk may be through those funds. So our diversified funds, which some of you listening in may already hold within your portfolios, investment products that are managed by our investment strategy group and have allocations to a range of different defensive and growth assets, all in one pre-blended product. The conservative fund, as the name might suggest, which is the left-hand dark blue line, is a 30% equity, 70% fixed income. So conservative, so the name would suggest. Through to the right-hand side on the green line is our high growth fund, which is 90% equities and 10% fixed income. So a lot more higher risk product. When we look at these left-hand four bar charts here, what we're looking at is the probability of achieving a real return target. And when we talk about real return, that's the return of your portfolio over and above the level of inflation. So what you're making after cash effect. And what you can see here is if you do want to receive a higher return, you are going to have to take on more risk and go further into equities over a longer period of time. But with that as well, what we like to look at is then what's the downside risk of taking on a higher amount of risk. So you may just think, oh, well, I'll move up the spectrum because I want a higher return, but you may not be able to open yourself up to that kind of risk. So on the right-hand side, we chart the potential downside risks. So you can even see with even a conservative portfolio on a 1-year basis, which is what we've charted here, the probability of an outcome in at least one of the next 10 years that you would see a return worse than these figures. So even with a very conservative product, you're still likely to see a fund perform 0% or worse, as just markets can move that way. So you could see a -1 or 2% in a very short term. But as you can see, as you move to the greater drawdown risk, so what are the odds that portfolio might have a performance of 10% or worse in a given year or 20%? the more defensive your portfolio, the less likely that is. Whereas the more open to equities you are, the greater the risk of that occurring is. So even though you may want to get a return of 5% or more, for example, and you want to increase the chance of that, you may not have the time horizon or also the risk tolerance to sit through a year where performance of your portfolio does negative 20% or worse. But if you're interested in finding out a little bit more about your own risk tolerance and maybe your own portfolios, again, feel free to speak to your advisor at Canars, and they'd be more than happy to run you through what you're investing in at the moment and maybe revisit what your own tolerances are. Just in summary, before I throw to questions and see if we've got any on the line, again, one of the key things we're seeing is immunity gap and vaccines. So we're going to see countries continue to vaccinate and look to close immunity gaps within their own borders. And we see that this is going to play an important role in markets and also when we may be able to see global travel and global trade get back to sort of normality. But what we are seeing, though, is market sensitivity to COVID-related news will continue to reduce. So essentially, like snap lockdown we're seeing here or lockdown around the world, we're going to see a reduced impact because we can see that they're not going to be as long or we have better containment measures. For global inflation, we see this playing a really important factor in the markets in the short term. As I sort of touched on earlier, we're not seeing this as a return to really high inflation for long periods of time. We're seeing it more of a modest short-term impact. Then when it comes to global asset returns, as I touched on, portfolio returns overall have been tempered slightly, but then also recent market performance has also reduced our equity forecast as well. So we have more of a conservative view of what the markets might return over the next 10 years. We'll just check now if anyone wants to unmute themselves and ask a question. I'll also check the chat to see if anything's come through.
Any questions for Bryce, guys? Can you hear me, Bryce?
Yeah, I can hear you. Thanks, Peter.
Yeah.
Sorry, I was checking something. How have you been?
Yeah, good. No other questions for Bryce. It's interesting, obviously, what's happening at the moment. Obviously, these snap lockdowns, what sort of impact does it have on the overall economy, mate, in your opinion?
Yeah, so it's probably quite a minimal one in terms of, it's only 7 days and it's only going to impact Victoria. And I think just the way, I guess, when governments have been much better at these and businesses are more adaptable, obviously it's not ideal. It might have a bit of a short-term impact to employment numbers and that sort of stuff down here in Victoria. Yep. But we just think that countries are getting so much better at handling this now, and hopefully it might be a bit of a kick that we need to get some of these vaccinations underway and really start to see the improvement. But yeah, in terms of the numbers, we're not talking massive numbers. I think it's sort of 25 here at the moment. It might get a little bit higher over the next few days as it settles, but I think these snap lockdowns are really effective at ending it quickly and getting everything back to normal fast. You guys have had a couple up in Queensland as well.
I guess it's just the level of government support with these ones. For example, if you're at a restaurant, it's Thursday day. They've probably ordered all their stuff for the weekend, haven't they? Somewhere along the line, someone's going to lose out a fair bit in that sort of hospitality space. Yes. And tourism, I guess.
Yeah, so I'm not sure what the government's proposed at the moment, but touch wood, obviously it's going to be quite impactful through as sort of those high risk ones I mentioned earlier. A lot of manufacturing will probably still go on. I think sometimes they fall under those sort of, they're able to keep going through. But yeah, unfortunately, it's a tough time. Our last snap lockdown was unfortunately through Valentine's Day weekend, which again, I don't think if you're a restaurant owner here in Victoria or anything like that, you're having a great time so far this year. Yeah,
exactly right. Positive though, is that when the more snap lockdowns you guys have, the more people move to Queensland. So
yes,
it's a little bit different, isn't it? It's
a bit of a funny thing in terms of just watching and seeing people almost fleeing the borders in the day today, and it's like that's not the point of the snap lockdown. Is not for you to get out in the day, but I've heard a few things around the rental market and property market in Queensland is booming as well because people are just relocating. I know our work's become quite flexible. Everything's sort of changing to not maybe necessarily need you to be at head office anymore. You can work from a satellite pretty comfortably.
Yeah, I've got a few real estate agents that we talk to quite regularly, and there's some of the stories I just would never have heard of it, like people from Sydney and Melbourne buying properties sort of on FaceTime and things like that. That's a bit different, isn't it, really? So Yeah, I think they're keen to get in quickly and move up here. So yeah,
Yeah.
and it'd be interesting to see what this effect has because it's right at the start of your winter.
Yes.
Yeah, if people sort of go, oh well, that's enough, we're moving out, and that helps our tourism and everything like that up our way. So it'll be interesting to see the effects of it sort of in the next 3 to 4 weeks because it'll all be a lag on effect for us. So
Yeah.
yeah.
We're interested, I guess, whether Queensland and the other states do any what do you call it, quarantine for anyone who's moved up. But honestly, how do you see China affecting outcomes in the near term? I guess it's sort of an open question, but I guess at the moment, I mean, China's make up roughly, I think, 18% of global GDP. So they're slowly becoming a bit of a powerhouse overall. I mean, I've touched on a previous update. We see that there's going to be still a lot of sort of tit for tat with China. We don't think that relationship's going to smooth over anytime soon. But essentially, what we view from that is we don't think that China will come after some of the larger export areas for us. I think I showed it in a previous chart that essentially some of our biggest trade partners are them. They also rely heavily on us for those products. So they're probably more so going to go for things that make a good headline and obviously try to make us sort of back off and maybe comply a bit more with them, but they're not going to go after, I think it was sort of iron ore and copper, which we produce a lot of because they need that for their own global expansion. But I mean, it will be interesting to see, I guess, how that relationship continues, and hopefully they can sort of start to make some amends to repair it or get it on amicable grounds because, yeah, I mean, they're such a big powerhouse and we wouldn't want to disturb that too much. But at the moment, we don't see it spilling over in a drastic way. We just see some short-term impacts we might see through that, just from a bit of volatility they may cause.
They're more in the luxury food market. Like, we wouldn't call it a luxury food, but for them, I've visited there, and that it's that luxury food market over there, isn't it? Like it was the wine, it was
the meat. I'm not sure that was meat, but yeah, some of those ones where we do a lot
barley,
of
I think it was
area, which obviously, again, like it's hard to sit there and say it's not going to be impactful, but I mean, if you're in those industries, it's going to be obviously massive impact for those ones. I'm sure there's a lot of exports going there, but from a global GDP standpoint, Australian GDP standpoint, it's not going to have a huge impact. We view those as sort of like high impact to the industry, but low impact they don't make up a significant portion of Australia's 100% GDP. They might make up sub 1%, which will have such short-term impact to the market, but won't have a long-standing impact on our economy. So it's kind of, I guess, like a bit of a warning shot that we can get from China without it being a direct impact.
Like, and we're massively coal here. Like, we don't we read about the iron ore stuff here, Bryce. We don't really see it like at all because it's just not done in our area. But isn't China like 15% of our coal export at the moment or something? It's quite low, isn't it, compared to what it was? They go to India and Japan and Korea and things like that.
So they've got alternatives. I mean, if you're interested in seeing any, you didn't catch one of my previous updates, I mean, I'm happy to share the slide which shows it's a good sort of X and Y axis that shows, I guess, our reliance on China versus China's reliance on us, and it shows, I guess, the areas that they could really come after us, the areas also that they wouldn't touch because it would impact them too much. It's essentially where, as you said, with coal, they can go to other areas, whereas for certain things that we produce that they don't have alternatives, we just don't see that they would go after those areas. So, and those typically tend to be some of our more higher GDP producing areas. I hope that answered your question, Jeff. Yeah, so crypto, I wouldn't call myself a bit of a crypto expert at all. But I mean, we came out in terms of one of our heads came out the other day sort of saying, I mean, we view crypto a little bit more so on the lines of collectibles, if to put it a simple way, in terms of we don't see it being essentially part of a base portfolio at the moment. There's just a lot of speculation and a lot of noise around there. I mean, if you've seen the volatility we've seen at the moment, I mean, some people tried to put it in place of alternatives like a gold at the moment in terms of way of storing capital. I mean, if you saw the volatility at the moment, I just couldn't see it in that space at all, at least at this stage. So we view it more of like my term would probably be sort of around that gambling side. So, I mean, whatever you're putting into that, probably be willing to also see go very high and very low. I wouldn't see it as part of a core portfolio. In terms of its external uses, in terms of banking, I'm not well versed in that area. I mean, if you wanted to, be happy to pass that question through and come back to you. But yeah, in terms of its functional uses, I mean, I'm not well versed. I mean, I've just sort of seen it as the investment side.
Great story about crypto, Bryce. I had a client email me. They wanted to know how to get it out tax effective because they were making a killing on it. So I was like, oh yeah. So I gave him a phone call and left a message. Then they called me back 2 weeks later. I called him again and I said, oh, just returning a call about the crypto. He's like, oh, don't worry about it now. I've lost it all.
Yeah,
it's just, yeah, it is what it is, isn't it, really?
From tax gains to tax losses within 2 weeks. So it's I mean, it's incredibly volatile. I mean, you hear the stories. I think everyone's sort of like that gold rush. I think everyone hears someone do really well. So then but I always, I mean, my opinion with crypto, if you're hearing about it, you're probably too late to the party. But we've all been proven wrong over the last 5 years. But again, it's just when you buy in. But yeah, we don't view it. It won't be coming into our portfolios. It's not a space we're looking to play in anytime soon, even from an investment or a back end, I don't think.
It's more like that seed funding sort of thing too, isn't it? Really, kind of like, you know, how there's some like those very early startup stocks that people jump on at 1 or 2 cents.
Yeah,
you'll get like one out of every sort of 10 or 15 that'll do all right for you, and you'll be prepared to lose it with the rest of it. Like miners were like that 15 years ago, weren't they? Really, everyone had a mining stock, and then they just went nowhere. So in tech stocks in the late 90s. So
yeah, exactly. So in terms of all will do well for a while, and then I think you'll see volatility that we saw, and I think you'll see some fall away and some will hang around, and you'll find, I guess, some which were propped up by nothing and some actually mean something. I mean, again, I don't really know too much about crypto. I know the sort of headline ones, and I mean, there's hundreds and thousands of spin-off ones and all that sort of stuff. I mean, who knows what's actually being used for what and what they are. So yeah, unfortunately, I probably can't tell you about the ones what aren't Bitcoin. I mean, I know the key ones like Ethereum, all that sort of stuff, but yeah, maybe a little bit out of my depth there.
Stick to the blue chips, mate. Hey.
Yeah. Index, yeah.
Blue chips and property trust, you reckon?
Yeah.
Very good. Any more questions, mate, or we might wrap up? Or
yeah, I'm just checking. I think another one from Jeff. I'm retired and most interested in capital retention again. I'm just reading that. I'm retired and most interested in capital retention. A younger person is interested in gains rather than protecting capital. How do you reconcile the conflicting approaches? Yeah, I guess, well, I mean, you'd build, if you're talking about 2 different people, I mean, not to provide advice, but you would have very different risk profile tolerances. So on that screen I showed earlier, you would find yourself falling somewhere along that conservative to high growth spectrum. And then that's the way you would start to approach your portfolio. But I guess if you're looking to build a portfolio again, fortunate enough, you've got Canars here, so feel free to reach out to them and they can help you with your portfolio if you're not already dealing with them. So yeah, in terms of recommending how you go about that, that's something I can't really touch on. But in terms of how you differentiate that, again, you can see even in your comment there, you've got very different risk approaches there. So you'd find that you'd have very different weightings to growth assets and defensive assets. So that's something you would work if you're trying to blend a portfolio through the 2 people. Yeah, probably something to speak to an advisor about how you would find the happy medium there.
Yeah, I'm obviously not on the financial planning side, Bryce, but effectively what they do is a risk profile and a fact finder up front. And so that's the process of getting to know each individual client, what their client needs are, what their appetite is for risk. So exactly what the question was. It's like if you're a bit older, you a lot less risk. If you're younger, you might be happy to play a bit more risk because you can ride the waves, the ups and downs and that. So that's all taken account of in the fact finder process, which is the initial process. I know Jake's on the line, so feel free to jump in if I'm wrong, Jake. But essentially that's what we get to do is we get to know the client up front, know what their scope is, what their desired outcomes are, and then we use the assistance of the Vanguards and the likes to build a model portfolio around those. But yeah, each person is different and they all fit into a different box. And 2 people the same age, for example, myself and Andy, who also works here, we could have totally different levels of risk and levels of what we're happy to invest in and what we want out of it as well. So Andy might fall into the category the same as somebody who's older, but then someone who's older might also fall into my category, just depending on what their appetite is and how they're geared, I guess.
Yeah, perfectly said. But if you do obviously want to know about your own situation, Jeff, yeah, you know where to reach out, which is
Yeah.
good.
Brent and Jake and the guys at KFS, that's for sure. So
Yeah. I might wrap it up there.
Yeah.
Do you want me to pass the?
can you flick it back to me, mate, if that's okay?
Yeah.
I don't know.
Do
You
that.
know how to do that?
Make host. Yes.
I think I'm the host now. Cool.
And I'll stop sharing my screen. Perfect. So that's over to you now. So yeah, you can obviously
Get everyone at the top there.
still recording.
Excellent. No dramas at all. So no, I just like to thank Bryce for coming along again today. Thanks, Nate, for your insight. I really enjoy your talks, even though I missed the first 5 minutes of this one. But I really, I love the graphs, and it's also good to get a bit of an update of where we're at the market and also your own insight. I'm sure they've all given me the lockdown jokes before I rocked on, but I hope you enjoy seven nights with your family there. And 5 kilometers around you by the sound of it.
So the walls get smaller when you're in lockdown. But no, I appreciate you guys letting me come along and present again. And as I mentioned earlier, if there's any questions that come through after the fact from the recording or anything like that, send them through. But yeah, everyone stay safe, and we'll hopefully speak again soon.
Yeah, no, excellent. If you have any other questions, we can obviously help you out here at Canars. Or if there's something specific for you, Bryce, we'll get in touch with you and go from there as well. Hey, thanks also for Jakey for sitting on the line. Brent's off at the moment as well. So, and thank you everyone for your attendance. And we'll get another webinar going next month. We haven't really decided on the topic yet, but it will come through, and we'll send it all through via our channels. So, have a safe night and enjoy the cool here in Rocky.
Thanks, Pete.
Thanks, mate. I'll just